Cheap money, that sounds like something that I should like. Or is it something more sinister? What does it have to do with inflation? Are there any potential downsides or upsides to cheap money? We'll explore all that and more on this episode of Finance Squared. So lovingly, tenderly, gently, smash that like button for the YouTube algorithm, and let's get started. You're watching Finance Squared, and I'm your host, Derek West. And on this channel, we love talking about all things personal finance, including stocks, bonds, crypto, credit, debit, and so much more. If these sorts of topics are up your alley, do yourself a favor and subscribe to this channel with post notifications turned on so you don't miss it when we break down great topics, like cheap money, for example. When someone says cheap money, what exactly are they talking about? How can money be cheap? And conversely, how can money be expensive? To understand what they're talking about, you need to understand some basics about money in general and how it moves through an economy. Money is almost like a commodity. Well, it isn't a commodity. You can't take it and add value to it, then resell it to consumers as something new, like you can with, say, corn, wheat, or lumber. But in many ways, it is. Everybody needs it, everybody wants it, and it is widely used throughout all economies somewhere on Earth. When the supply of it is low, there can be panics, and the price of it can go high. For example, during the early stages of the Great Depression, one of the more interesting phenomena that occurred during that time were bank panics, when deposit holders would all rush to bank and demand that they have their money back all at the same time. But even back then, thanks to fractional lending, banks didn't have the money for all those customers at that time. And every customer withdrawing their cash at the same time was a recipe for that bank to fail. Keeping in mind that banks are businesses, just like grocery chains or restaurants or tech companies or any other type of company that you can think of. The difference is where they get their product and what their services are. You see, a bank's product is in fact money. Their goal is to serve customers who need money to purchase things that they need or want in a reasonably safe way in order to make profits for themselves and their shareholders. And just like other type of companies, banks come in different sizes and flavors to serve the different needs of different customers. Whether we're talking about retail banks, which tend to serve your everyday retail customer through loans such as car loans, mortgages, and credit cards, or if we're talking about investment banks, which tend to serve larger institutional customers who tend to focus on investment-grade money finances for things such as IPOs or when issuing debt in the form of bonds or derivatives of various investment products. Or finally, central banks, who you can consider to be the bank for other banks, large institutions, and even, or I guess especially, for governments. Central banks can also be considered money wholesalers, who really grease the skids for the entire economy to work. You see, at least in the United States anyway, the central bank of record, the Federal Reserve, lends money to other banks to help them meet their reserve requirements so that customers can be sure that their bank will not run out of money if large numbers of people demand their money back at the same time, like what happened in the Great Depression. So you can see, the demand for money is all around us. But what happens when the money supply surpasses the demand for money? Well, ladies and gentlemen, that is what you call cheap money. But how and where does cheap money come from? Well, we just talked about the different types of banks: retail, investment, and central banks. Central banks are sort of the root of all discussions on the value of money because they effectively control the supply. Central banks have several tools in their tool belts to change whether money is cheap or whether it is expensive. And the one that most people hear about most often is the prime rate. When the Fed raises the rate at which they loan money to other banks, the prime rate jumps right along with it. The prime rate represents the credit rate that banks extend to their most creditworthy customers, which is why they call it a prime rate. It's the best rate that you're going to get. This rate is the one which other forms of consumer credit are based on. A higher prime rate effectively means that banks will increase fixed and variable rate borrowing costs when assessing risk on credit-worthy companies and consumers. Now, this affects all kinds of financial products and services. For example, with credit cards. Higher prime rates means higher credit card rates for consumers who carry credit card debt. At least a quick sidebar. To avoid having to run into high credit card interest rates, simply paying off your credit card balance in full as soon as you can, but definitely within a month of making a purchase, will help you to avoid high interest rates. For more on this, feel free to check out one of the videos that I did or others have done on credit card tips and tricks. Prime rate's effect on savings is a little bit different. See, money market and certificate of deposit rates will increase or decrease based on changes in the prime rate. Theoretically, if the prime rate goes higher, making money more expensive and less cheap, then savings among consumers of products such as CDs, they could see a boost because they can get a higher return on their savings. But if that same prime rate goes lower, then that means the money becomes cheaper, and cheap money means savings become harder for regular people, and those same people would probably benefit from taking a look at alternative mechanisms to create and preserve their wealth, like the stock market, for example. But the prime rate's effect on auto loans is similar. Like other short-term money lending products, auto loans will see their interest rates go up if the prime rate goes up as well. Keeping in mind that a high prime rate will mean more expensive money and not cheap money. Like a lot of other phenomena, cheap money will mean cheaper auto loans, which in turn causes more auto loans to be issued, assuming the supply of creditworthy buyers can keep pace, which can be a little bit of a problem in the economy as well. For example, what do you do when you run out of creditworthy buyers? Do you give loans to uncreditworthy buyers, risking defaults? That was the cause of the 2008-2009 financial crisis, the last crisis during the cheap money era. Speaking of which, higher interest rates can lead to cooler demand in the housing sector because higher interest rates will mean higher mortgage rates. This will make the total cost of home ownership go through the roof, making it even more of a poor investment than it already is. For example, for a 30-year loan at 4.65%, a home buyer can anticipate at least 60% of the principal over the duration of the term of the loan. So right now, the US and quite a bit of the rest of the world are in a cheap money era. That means lots of low interest rates for things like credit cards, automobiles, and mortgages, which of course means more and more of those products are flying off the shelves, and automobiles off the lots and showroom floors, and of course lots of construction for homes and remodels. And with spending plans currently set to inject even more cash into the economy, even more cheap money will be ever present. The thing is, this has an unfortunate side effect. The reality is nothing is ever all good, and too much cheap money can lead to everyone's favorite economic phenomenon, inflation. And I'm sure by now everyone knows what inflation is. Inflation is most always the consequence of too much money chasing too few goods and services, thus outpacing the growth of the rest of the economy. This can cause many side effects that can lead to negative consequences for the health of an economy. Inflation has ravaged nations such as Venezuela and Zimbabwe, giving the people of those countries zero confidence that the money that they use is worth anything, negatively affecting trade and the economy in those places. A similar thing can happen in the US if cheap money policymakers are not careful about how they handle the expanding supply of money. But expensive money can also have a negative effect as the US dollar rises against foreign currencies as a result of the Fed raising its interest rates. Companies that do business where the foreign currencies are popular can see lower sales. Expensive money can be damaging to the economy overall. It can mean less borrowing or refinancing of existing debts because, frankly, it can be more expensive. Imagine refinancing a home at a 12% interest rate. If when you first got the mortgage it was about a 4.65% interest rate, there'd be no economic incentive for anybody to do that, limiting the number of home refinances, which would decrease the amount of home remodeling, limiting the construction industry. It will also keep people from taking the plunge and buying a new home, thus causing construction on new homes to dwindle, not to mention the effect it will have on the automobile industry. Higher interest rates for car loans would make the cost of ownership of automobiles that much worse, helping to encourage people to wait even longer before they get into their next automobile. The effect of expensive money on the economy could be bad overall. Expensive money could lead to a deflationary spiral, deflation being everyone's most disliked economic phenomenon. Where the prices of everything continues to fall, causing businesses to lower prices to get customers to pay for their goods and their services. The lowering of those prices will cause lower wages and even layoffs, continuing to damage the economy and the ability of people to pay for those goods and services, putting everyone in a generally sour mood. So the next time someone says cheap money to you, you'll know exactly what they mean and how cheap money can be both good and bad for you depending on the circumstances. And you know what? In circumstances like the ones we're living in through today, people need high quality financial content served to them piping hot on a regular basis. Get your serving by subscribing to this channel with post notifications turned on so you don't miss a single morsel of this high quality financial feast. I'm not sure I'm getting into food metaphors at the end of this video. It could have something to do with the fact that I'm starving. Anyway, remember that a goal without a plan is a wish, and a goal with a plan and no action is a wish list. I'm gonna get out of here and go grab a bite to eat using all of my cheap money. I'll catch you guys next time. Peace.